Hello everyone. In this particular presentation, we're going to talk about long-term liabilities. Specifically, we're going to talk about bonds payable. Okay, what is a bond? I'm sure a lot of you have heard about stocks and bonds. A bond is basically an interest-bearing note, but instead of borrowing the money from a financial institution like a bank, the bond is basically when the company goes out to the investing public and they borrow money from the public. And basically the investor, the bond investor, is going to ask for his principal amount back plus interest over the term of the bond. So basically that's what a bond is. It's investors that are letting the company borrow money, but of course that money needs to be paid back with interest over time. Okay, let me get a slideshow going here a little bit better. Okay, so what is a bond? Like I said, it's normally it's principal amount that's loaned out to the company. Each bond has a face amount. The face amount is called the principal. That's the amount that is actually lent that needs to be paid back. And the principal is usually in multiples of $1,000. The interest is payable annually, semi-annually, quarterly, sometimes even monthly. And the contract between the investor and the company is called the bond indenture. Okay, there are two main types of bonds. The first type is called a term bond. The second type is called a serial bond. A term bond is when all of the principal is paid back at the end of the term. So during the period that it's outstanding, it's interest only that's being paid by the company to the investor. On the other hand, a serial bond is when the principal amount have a series of payments throughout the bond term instead of one lump sum at the end. Okay, let's talk about issuing bonds. Now, what you have to understand is the market, right? The going market has an interest rate. So as you understand, you know, if you read the Wall Street Journal, you will understand what the going interest rate is at any given time. Okay? Well, that interest rate is basically the effective rate, all right? That is going to help determine the sales and the purchases of bonds. Now, that may be the market rate may be different than the contract rate. The contract rate is the actual interest that's going to be payable in the bond contract. So when we compare the market rate and the contract rate, we can determine if the bond should be sold at more or less or at the same amount as their face amount. All right, so here is the rule. If the market rate is greater than the contract rate, what are we saying? Think about it. We're saying, hey, I am getting paid less in my contract than I can get anywhere else in the market. Why in the world would I buy this bond? I would only buy it if the bond is sold at a discount. Look at the middle part here. If the market rate and the contract rate are equal, then the bond is going to be sold exactly at the face amount. But over here on the far right, what's happening? The contract rate on the bond is greater than the market. So we have a lot of demand. If we were a company and we were giving interest greater than anybody else in the market, we would have a line out the door to buy our bonds. So because of the position that we're in, we are going to be able to sell the bond at a premium. All right, now when I say discount and premium, the discount means I'm selling the bond for less than its face value. When I sell it at a premium, I am selling it at a higher amount than its face value. Okay, so let's take a look at an example here. So if I sell the bond at a discount, and let's say for an example, a $1,000 bond, if it's quoted at 98, what that means is we're selling it at a 98% of the face value. 98% of 1,000 is $980. So we're selling it for a discount. Now look at the second bullet point. Let's say the bond is quoted at 109. That means we're selling the bond at 109% of the face value. or $1,090. So you can see, hopefully from this slide, when we sell a bond at 100, we're selling it exactly at face value. If we sell it for less than 100, we're selling it at a discount. If you sell it for more than 100, you're selling it for a premium. So here is the example for the accounting journal entries. Finally, this is the most important part. Here's the example. January 1 of the first year, we sell a bond. It's got a face value of $100,000. The contract rate is 12%. The market rate is also 12%. So when this is the case where the contract and the market are exactly equal. And the bond term is 5 years. Interest is payable 2 times a year, semi-annually, on June 30th and December 31st. So the first journal entry when we sell the bond, because we're not selling it at a premium or a discount, we're simply going to increase the cash account with a debit, and we will increase our bonds payable account with a credit. No premium, no discount. That was on January 1st. Now, June 30th and December 31st is when we need to pay interest. So June 30th, we're going to record our interest, and the interest is going to be, as you remember your formula, the principal of $100,000 times the interest rate, 12%, times the time. We're talking about a half a year. When you do the math, that works out to $6,000. So on June 30th, we will debit interest expense, and we will credit cash. And basically, we're going to do that calculation every June 30th and December 31st. And that goes on for 2 times a year for 5 years. And since this is a term bond, at the end of year 5, we are finally going to pay back our principal. So we will decrease the bond payable with a debit, and we will decrease cash with a credit. So here's an example. No premium, no discount. It's a term bond. Interest is paid twice a year, and the $100,000 principal is paid back in full after 5 years. So that's bonds issued at a face amount. Now let me go through when we issue bonds at a discount. And once again, bonds are issued at a discount when the contract rate, in this case 12%, is less than the market. So we're saying, hey, investors, you can get 13% anywhere else. So why in the world would you buy my bond for 12%? And the issue is we need to sell it at a discount. So here's how it works. We're going to credit bonds payable for the full face amount of $100,000. But if the bonds are sold at a discount, the company is going to receive cash less than the liability. So here's the case where the bondholders are only giving the company $96,406, even though we need to pay back the full $100,000 at the end of the bond term. The difference between the cash received and the liability is either a discount or a premium. In this case, it's a discount because we are receiving less cash than the payable. This discount is a contra liability account. This discount is actually going to be netted against the bonds payable for presentation in the liability section on the balance sheet. This discount will be amortized over the life of the bond. And that takes us to the next slide, amortizing a bond discount. So basically what we're going to do is, remember the discount, if we see here, it's got a debit balance. So how do I amortize this debit balance? Well, I will credit it. And when you credit it, what are you doing? You are actually debiting interest expense. Effectively, the discount is extra interest expense that we will recognize over the life of the bond. Okay, so that is a journal entry that we are going to record every single time we record interest. There are 2 methods to do this. We have the easy method, which is called the straight line method, and we have the effective interest method. I'm going to show you the straight line method now, but I will show you the effective interest method towards the end of the lecture. The effective interest method, by the way, is required by GAAP, but it's more complicated to figure out, so the straight line method can be used if it is fairly similar in dollar amounts to the effective interest method. So here's the straight line method. So we had the discount, if you recall from a few slides ago. The journal entry, we debited this discount account for $3,594. It's a 5-year bond, and we pay interest 2 times a year. So 5 years times 2 times a year, that equals 10 interest payments. So if we take the $3,594 and divide it by 10 interest payments, that means every single time we pay interest, we are going to amortize our bond discount $359.40. Here's the journal entry. As we stated earlier, do you remember we calculated that the interest payments are actually $6,000 every time we make an interest payment? However, in this case, when we issue the bonds at a discount, we have to credit the discount for the amount that we're going to amortize it for. The sum of the cash interest payment plus the amortization of the discount, the total is the interest expense. So you could see the interest expense when we have a discount that we're amortizing, the interest expense is actually greater than the cash interest payment we are making to our bondholders. And the effective interest method, I will show that to you in a few moments. Okay, now let's take a look at issuing bonds at a premium. Similar example, the face amount of the bond is $100,000. The contract rate is 12%. Still a 5-year bond, pays interest 2 times a year. But in this case, the market rate is 11%. We're actually paying interest more than the market. So people are going to be willing to pay a premium to us for that extra interest. The premium is when we actually collect or we sell the bond at a higher amount than the face value. So here's the example, same $100,000 bond, we'll credit bonds payable, but we're able to sell it for $103,769. We sold it for more than the face value. The difference is a premium. And a premium, unlike a discount, a premium is going to have a credit balance. The premium and the bonds payable are going to be added together in the liability section on the balance sheet. And just like we amortized a bond discount, we're going to do the same thing with a bond premium. It's just the exact opposite though. Remember, a premium has a credit balance. So to amortize it, I will debit the premium, and the credit is going to go to interest expense. Here's the real life example. We just saw that we entered into a bond by selling it at a premium of $3,769. It's a 5-year bond, paying interest 2 times a year. So there are 10 interest payment dates. If we are using the straight line method to amortize the premium, we will take this premium of $3,769 divided by the 10 periods, and we get $376.90. So on the first interest payment date, June 30th, we still have our credit to cash for $6,000, but we have to amortize the premium. And remember, premiums have a credit balance, so I will amortize them with a debit, and the difference is going to go to interest expense. So you can see this is the exact opposite of what we saw with the discount. With the discount, after we amortized the discount, the interest expense was greater than the cash payment. Here with the premium, after we amortize the premium, we can see the interest expense is less than the cash payout to the bondholders for their interest check. All right, and in a few moments, like I said, in one of the appendix to this chapter, I am actually going to walk through the effective interest method to show you the differences. Okay, next topic, bond redemption. Sometimes when the bond is entered into, the corporation has the ability to redeem or call the bonds, effectively pay off the bondholders before the maturity date. Okay, it's kind of like if you own a home and you have a mortgage and you want to pay off that mortgage before its actual due date, or if you wanted to refinance the loan, you pay off the loan with a new loan. These are all options for for mortgage holders. Well, it's something similar to companies that actually have bonds. they can call the bonds and redeem them earlier. Callable bonds, as they're called, there is going to be in the bond indenture, there's going to be a callable feature, and there's going to list out all of the details of the prices. There'll be certain prices that the bonds can be called at. And the call price is normally above face value because you have to protect the bondholders. The bondholders want to make sure that they're going to get something if they agree to buy a callable bond. All right, and because the callable bond has a certain price in the bond indenture, we can calculate a gain or a loss on the sale of the bond. Here's the example. June 30th, we have a $100,000 bond payable on the books. We also, at this point in time, have a $4,000 premium on our books. The bond payable has a credit balance. The premium of $4,000 has a credit balance. So let's assume that on June 30th, the corporation redeemed 1/4 or 1/4 of the $100,000 bonds. What's 1/4 of $100,000? That would be $25,000. And what's 1/4 of $4,000? The answer would be $1,000. So in your journal entry, we're going to get rid of the bond payable of $25,000. We're going to get rid of 1/4 of the premium with a debit of $1,000. And it says the callable feature allows 1/4 redemption to be sold for, or to be redeemed for $24,000 cash. So the company can write a check, so we'll credit cash for $24,000. And you can see we have a $2,000 credit that's missing in the journal entry. That is a gain on the redemption of the bonds. And let's take a look at a loss. Here we're calling 3/4 or 75,000 of the bonds. So we'll get rid of the bonds payable, 75,000. We'll also get rid of 3/4 of the $4,000 premium. That would be 3,000. We'll debit the premium. And the callable price for 3/4 of the bonds is $79,500. So we'll write a check and we'll credit cash for $79,500. We have a missing $1,500 debit. That is a loss. Remember, losses work like expenses. They have debit balances. They reduce equity, retained earnings. Gains work like revenues. They have credit balances. Ultimately, they increase retained earnings. And how are bonds reported? Once again, as I told you, the bond payable is going to be in the long-term liability section. If there is a discount, we will actually reduce the discount because it has a debit balance, and we'll show the net amount. If there was a premium, we would take the bond payable and we would add the premium and show the two of them added together. So ultimately, they're both shown in the liability section. Okay, so the last thing I wanted to go over with you is actually I'm going to flip all the way through Appendix 1 and I'm going to go all the way to Appendix 2. Appendix 2 is where I'm going to show you the effective interest method for amortizing premiums and discounts. So here's the first example, amortizing a discount using the effective interest method. If you recall, back on our studies earlier in this chapter, we sold a $100,000 face value bond. When we sold it at a discount, we sold it for $96,406. And the difference between the two, hopefully these numbers are familiar to you, was the discount on the bonds payable. So instead of amortizing it using the straight line method, we are going to put a table together that looks something like this. So in the first row, all the way over in column D and E, column D is the discount at the beginning of the bond, and column E is the carrying amount. The carrying amount is going to be the face value, in this case $100,000, less the discount, which is column D, $3,594. So in the beginning it's $96,406. And then what we're going to do, every interest payment, and like we laid it out, the interest is paid every June 30th and December 31st of each year, year 1, year 2, year 3, year 4, and year 5. Column A is going to be the actual interest paid, and that is based on the contract rate. The contract rate, if you remember, was 12%. So you remember the formula is principal of $100,000 times interest rate, 12%, times time, half a year. And that's where you get $6,000 is paid every single interest payment because it's a term bond. Now, column B is the interest expense. Now, the interest expense is based on not the contract rate, but the market rate. And in this example, the market rate was 13%. So the interest expense is going to be principal times interest rate, so 100,000. It's going to be the interest expense is going to be based on the carrying amount, 96,406 times 13% times half a year, and that's where you get the 6.5%. It's 13% for half a year. When you do the math, it's 6,266. Right? The difference between the two will be what we amortize the discount. So in the first interest payment, you can see the expense is $266 than the actual interest paid. The difference, or $266, is the discount. So if the discount had a balance of $3,594 minus $266, the new discount balance is $3,328. And the new carrying amount is $100,000 minus $3,328, or $96,672. By the way, if you add up column D and E on every single row, they always add up to $100,000. And so the next interest payment date, I won't go all 10 of them, but the next interest payment date on December 31, we're going to take the same interest as to be paid of $6,000. Now the interest expense, it's going to be the new bond carrying value at the beginning of the period, which is $96,672 times 13%, which is the market rate, times half a year. And you can see the interest expense is $62.84. Subtract it from $6,000. The difference of $284 is the amortization. If our balance was $33.28 before we amortized, minus $284, the new discount is $3,044. And your carrying value is going up. And you can see your discounts are going down. By the time we get to year 10, you can see we have no more discount, and the carrying value is exactly the face value. And it works the same. Here's the journal entry. You can see for the first year, when we had $6,000 payment of interest, the expense is $62.66, and the discount amortization is $266. Here's your journal entry. The interest expense is the full $62.66. The discount amortization is only $266, and there's the $6,000 cash that we're paying our bondholders. By the way, the bondholders, they don't care about this. They just care about the $6,000 check. All right, and now the premium. The premium works very similarly with the effective interest method. It's just that instead of column D and E adding up to $100,000, it's E minus D equaling $100,000, in this case, the face value. Same thing, the interest is going to be based on our contract rate, which is 12%. That's the cash payment. And the interest expense is going to be the carrying value before the interest payment. So in this case, $103,769 times the market rate, which in this case was 11%, times half a year. That's where you get your 5.5%. So if you do the math, the expense is $5,707. The interest paid is $6,000. The difference between the two, $293. That is the amortization of the premium. If the premium did have a balance of $3,769 minus the $293 premium, that gives us the new premium balance. And of course, the carrying amount is $100,000 plus the premium. You're going to see by the time we get to the end, the premium is a 0 and the carrying amount is the full $100,000. So the journal entry, as we can see, the first one on June 30th, the interest paid cash of credit of $6,000, which we have here. We amortize the premium, $293. Remember, premiums have a credit balance, so I will amortize it with a debit, and the difference is the interest expense. So in this chapter, we learned about what a bond is. We learned about selling a bond at face value, selling a bond at a premium, selling a bond at a discount. We learned about amortizing discounts and premiums using the straight line method, also the effective interest method, which I'm showing you here. And we also talked about redeeming or calling bonds. And when bonds are callable, they are also possibly recording a gain or a loss on that callable feature.